Imagine waking up one morning, opening your banking app and seeing a message you've never seen before. Not insufficient funds, not a transaction declined, something stranger. Something that says, withdrawal temporarily restricted. You call the number. You're told your account is under a liquidity review. You ask what that means. There's a pause. Then, we'll contact you within 5 to 10 business days. You have bills due tomorrow. Now, here's the thing. That scenario isn't fiction. It's not a dystopian thought experiment. It's a legal possibility. And depending on where you bank and how much you keep there, it may already apply to you. In 2026, a set of banking regulations quietly took effect across multiple countries. Some coordinated through the Basel Committee on Banking Supervision, others enacted at the national level, and a few buried inside omnibus financial stability bills that nobody outside of banking law departments actually read. The press covered it as new capital requirements. The banks described it as enhanced depositor protection. Almost nobody explained what it actually means for the person with a savings account. We're going to do that today. To understand what these rules say, you need to understand what problem they're trying to solve. In March 2023, Silicon Valley Bank collapsed in 48 hours. 48 hours. It wasn't a slow-motion failure. It was a digital bank run, the first of its kind at that scale. Depositors got the news on Twitter, opened their banking apps, and hit withdraw before the bank could react. By the time regulators stepped in, $42 billion had been pulled in a single day. More money moved faster than in any bank run in American history, including the ones from the Great Depression, which took weeks. The FDIC covered insured deposits up to $250,000. But here's the detail most people glossed over. At SVB, 94% of deposits were above that limit. Most of the money sitting there, from startups, from payroll accounts, from ordinary businesses, was technically unprotected. The government stepped in anyway. This time, regulators around the world looked at what happened and reached the same conclusion. The speed of modern banking has outpaced the rules built to govern it. When a rumor can go viral at 9 a.m. and trigger a full bank collapse by 3 p.m., the entire system needs new shock absorbers. The 2026 rules are those shock absorbers. The question is, who absorbs the shock? Here's the basic model most people carry in their heads about banking. You put money in, the bank keeps it safe, you take it out when you want. That model is wrong, and it has always been wrong. The moment your money enters a bank, it legally stops being yours. You become an unsecured creditor. The bank owes you the money, it doesn't hold the money. Your deposit is, in technical terms, a loan you've made to the bank. In return, the bank pays you interest, or these days, in most major economies, not very much interest, and promises to hand it back on demand. What the bank actually does with your money is lend it out. Mortgages, business loans, securities. Some of it goes into long-dated government bonds, some into complex instruments with names most people have never heard of. Banks are legally required to keep only a fraction of deposits on hand at any time. This is called fractional reserve banking, and it is not a conspiracy. It's the designed architecture of modern finance. It's how money multiplies through an economy. But it also means that if everyone shows up to withdraw at once, the bank simply does not have the cash. Nobody does. That's the system. The 2026 rules respond to this by introducing what's being called liquidity tiering, a formal mechanism that gives banks explicit legal authority to delay, limit, or gate withdrawals during what regulators define as a stress event. Under the new frameworks, banks must classify their depositor base by behavioral risk. Large institutional depositors, hedge funds, corporations, other banks are classified as hot money. They leave fast in a crisis. Retail depositors, you, are classified as you're statistically less likely to run, which means from the bank's perspective, your money is a more reliable funding source. Here is where it gets uncomfortable. Under Basel III's endgame rules, which several major jurisdictions began phasing in through 2025 and 2026, banks must hold higher quality capital against their loan books. That sounds safe. It is in one sense, but the secondary effect is this. To meet those capital requirements without shrinking their lending, banks need more stable funding, and the most stable funding, by regulatory definition, is your retail deposit. So, the system is structured to treat your savings account as a strategic asset, one that the bank has a vested interest in keeping in place. The new rules in the EU's Banking Recovery and Resolution Directive, updated provisions in the UK's Financial Services and Markets Framework, and specific guidance from the FDIC in the United States all now allow for what's called a temporary stay on deposit withdrawals in the context of a resolution event. Resolution is the polite word for when a bank is failing. In plain language, if your bank is going under, regulators can pause your ability to withdraw for up to 2 business days, sometimes longer in exceptional circumstances, while they determine the scale of the problem and arrange a buyer or bailout. 2 days sounds long, unless you need the money in 2 days, and the threshold for what triggers a stress designation is not made public. It is not defined in statute in a way that gives depositors advance notice. It is a regulatory judgment call. There are no alarms that go off for customers, no announcements on the bank's homepage. One day, access is normal, the next, it isn't. At this point, banking communications teams around the world are preparing responses to exactly this kind of coverage. They will say, this only applies to extreme scenarios. They will say, your FDIC insured or FSCS protected deposits are safe. They will say, this is about orderly resolution, not confiscation. And to be fair, they are not lying. These rules are designed to prevent panic-driven cascades from destroying the banking system. That is a legitimate goal. Regulators learned hard lessons from 2008 and from 2023 about what uncontrolled bank failures do to ordinary people. But notice something in that framing. The mechanism for protecting the system is to restrict your access during the period when you most want it. That's not ironic. That's the design. The FDIC insurance cap in the US remains at $250,000, unchanged since 2008. After 18 years of inflation, that cap covers significantly less real-world business activity than it did when it was set. For households, it's usually adequate. For any small business running payroll or managing receivables, often not. And the UK's FSCS limit is £85,000, which sounds like a lot until you remember that the average UK house price is over £280,000. If you've just sold a property and the proceeds are sitting in a current account while you arrange a purchase, congratulations. A significant portion of your money is technically unprotected. The rules do contain temporary high balance protection in some jurisdictions, a grace period of up to 6 months for exceptional deposits from life events like property sales. But you have to know to ask for it. It is not automatic, and most people have never heard of it. Zoom out a level. The 2026 rule changes don't exist in isolation. They're a node in a much larger rewiring of the global financial architecture happening right now, simultaneously, quietly, and mostly outside the frame of mainstream news coverage. Central bank digital currencies are moving from research papers to pilot programs in over 130 countries. The digital euro has an active development project. The digital dollar has ongoing congressional debate. Why does that matter here? Because CBDCs, if widely adopted, would give governments and central banks something they have never had before: the ability to see every transaction in real time, apply spending conditions programmatically, and, in theory, introduce time-limited or category-limited money. Proponents call this financial inclusion, efficiency, and fraud prevention, and those benefits are real. Critics call it the infrastructure for the most powerful monetary surveillance apparatus in history, and that's not an unfair description either. The 2026 deposit rules, the Basel Capital Framework, the CBDC pilots are not the same thing. They come from different agencies with different mandates and different intentions, but they are all moving in the same direction, a direction where the conditions of your access to your own money are increasingly set by institutions, not you. That might be fine, depending on how those institutions behave over the next decade. Here's what we know. Banks now have clearer legal authority to restrict your access to deposits during a stress event. That authority exists in law across most major developed economies. The protections, deposit insurance, resolution frameworks, are real. They do, most of the time, protect ordinary depositors from ordinary bank failures. But the system was designed for a slower world, and the updates to that system were designed primarily to protect the system, not you. The assumption embedded in all of this is that the institutions managing these mechanisms will be competent, honest, and functioning when you need them to be. History suggests that assumption is usually correct. History also suggests it isn't always. There is a version of this story where 2026's
rule changes are exactly what they claim to be: prudent safeguards that prevent chaotic bank runs from destroying jobs and savings and communities, where regulators are the last line of defense between you and a 1930s-style economic collapse. And there is a version where this same infrastructure, once normalized, becomes the template for something else, something less clearly benign. We don't know yet which version we're in. What we do know is this: the moment you stop asking which version is unfolding, that's the most dangerous moment of all.